Can you talk about FX option first? I think for the FX option liquidity is first question which we should ask. Is it highly liquid in, for example, Singapore?
Yes. Actually, the FX option, as we know, FX turnover is the biggest market, in the world, yes, by the size. Every day we are talking about 4 trillion plus turnover. And out of this 4 trillion plus turnover in the FX market, 50 to 60%, it depends how you define it, is directly or indirectly coming from FX options. Okay. So actually the market has been very big. Mm-hmm. Yeah. Liquidity-wise, we are still talking about over-the-counter markets in the FX option, but international FX option market is so liquid that I think any corporates or banks or fund manager, they can develop strategy or portfolio assuming the liquidity has reached a level which you can strategize, mix strategy on different kind of opportunity. Unlike the traditional way of trading FX option, so for instance, in the past, when we are talking about Aussie against Korean won, if you think the Aussie dollar is going to appreciate faster than the Korean won, you will tend to buy a Aussie call and Korean put option, say 3 months. Right. But that trade basically is related to a direction. Right. So if you expect there will be a directional movement of Aussie appreciating faster than the Korean won, actually you simply need a forward contract. Might be 1 month or 3 months forward contract in the market. Yes. You don't need an option. So here, when we are talking about option up to this liquidity, they allow us to develop more different strategy. Mm-hmm. So the strategy include that when you are comparing the 1 month Aussie Korean won option, the volatility level, and the 3 months or the 6 month, so you create a volatility curve. Yes, in our jargon. Right. Yeah. And this volatility curve actually, will it be flattening or will it be steepening? Right. So this is a good strategy for you to develop to try to capture the opportunity in this option market, rather than to decide whether the Aussie will appreciate faster or slower than the Korean won. Right? So that's why this will be the first opportunity in the option. Second opportunity in the options that a lot of sophisticated investor, they will understand there will always a butterfly in the market. Butterfly, it means we are talking about 1 month Aussie Korean option, the premium, you pay this much. But if you want to pay a very unlikely two option, which is far away with the strike price, we call it very low delta option. Right. Then you will create a so-called, in a professional jargon, we will be saying a smile curve. Right. This smile curve actually will be overshoot when, for instance, over the last couple of months when the Australian dollar become very strong, so a lot of people want to buy the low delta option. Right. But this one might overshoot, and sometimes the wings might be flattening or steepening. And so you just
realize the profits.
Exactly.
After selling.
Yeah, so you will buy at the money, sell the wings, so you can benefit if they really flattening. Or in the opposite, you will sell this one and buy the wing, then you will benefit when they go the other way. So these are some of the examples which allowed us to develop more derivative strategy in the FX option. So these are the group 1, I would say. In the group 2, we are talking about the higher frequency trading. Higher frequency trading in the past, I think a lot of investment company or big corporate, they have experienced that some very good trading model or some very good investment strategy, if they try to put into a simulation, you will generate a very high return. And this high return compared with the risk, we talk about Sharpe ratio usually. So you are talking about the return after the risk-free rate against the risk. You will up to 2 times, 3 times the risk. So, which is it's a lot. It's very attractive, right? It's a very smart model. But however, when we are talking about high-frequency trading, it means you trade multi-times within 1 hour, for instance.
So I think you need a couple of assumptions. First, the option market should be very liquid, and you must have a bunch of listed options.
Yes.
And
yes.
then you must have also the system.
Yes, indeed. Going back to the option part, of course, at the moment, the over-the-counter option market is so big, but unfortunately, it's only available for big manager or big bank, institutional. So it's for the retail client or the high net worth individual, actually, the direction should be going into a more, how can I say, exchange-traded product, which allow a lot of high net worth individual or even smaller institution to participate. So that will create a more, how can I say, opportunity for them to, particularly to hedge their risk or generate the alpha. I think you're right.
Yeah, but the question then, my question is, if most of options are being traded over-the-counter market, then can it be matched actually with system trading? Because system trading is based on more like listed market assumption, right? So to me, it sounds a little bit kind of difficult.
Yes. Oh, it will be 2 different ways. When we are talking about over-the-counter, usually you can always get futures. I mean the option futures in the exchange. For instance, you can have in United States, you have it in IMM, different kind of FX options or even currency futures. But when you are talking about trying to price the option in different kind of dates, so you might need, how can I say, more listed currency option in the same exchange. So you cannot possibly have only 2 or 3 contracts in the exchange for one currency. And this is number one, you need to have more, of course, hopefully. Second, you need to have more currency options, more currency pair options listed into the exchange. So it will allow more participants going into the market and make the market even more efficient. Yes, so this is the direction actually. But before that, at the moment, of course, over the counter, because it's one-on-one request, so it's easier for big institution or big manager to get a price over the counter. But I think you are right that the market should go into that direction to allow more currency to be listed, I mean even currency option to be listed in the exchange. And within one of the, I mean for each of the currency, you should have more maturity so that investor can develop more, how can I say, diversification or using the different kind of strategy.
And enhance the return, of course.
Yes, of course. And of course, at a very reasonable transaction cost.
Okay.
Yes. So I think this is the part for the FX option. And like what we just mentioned about transaction costs, actually the transaction costs also involve not only to FX option, but also to FX forwards or even currency swaps. So in the past, like I mentioned before, that a lot of people believe high-frequency trading model are just good jumping here and there, try to catch different kind of mispricing in the market. But not anymore, because the computer or the networking or the internet or the information has been so fast. Mispricing is simply impossible, almost. And so the more sophisticated high-frequency model, or I should call it higher frequency model, actually we're targeting to trade multi-time within an hour. So in the past, if you trade or rebalance your position, rebalance your portfolio on once a month, then of course it's too late to react to the fundamental or even the market movement or any signal. Then you move once a week, and now it's once a day. But still, once a day is too slow.
Considering current market conditions, definitely.
That's why.
Right?
Yeah, I totally agree. Particularly last.
Japanese yen, euros move. More than two big tips.
Yes, every day almost. In the first part of August, and also after the tragedy in Japan in March, the movement has been up and down. You're talking about 5-6 yen, which is you're talking about 7% every day, which is too much.
Yeah, in currency market, it's too much.
It's too much. It's too much. So that's why we are talking about higher frequency model in a way that, in the long term, in general, so how to bring down the transaction cost. No matter you are an investor using currency as a risk hedge, to hedge against your exposure in your international portfolio, or you try to generate alpha, generate absolute return from the FX, transaction cost is always the number one enemy.
Right.
Yes. And so now what we are trying to develop pretty much in the last 3 to 5 years, we use different kind of machine learning techniques and also different kinds of in-house development in the execution platform, because over the last 5-7 years, actually a lot of execution platform, no matter is on the indexes, stock indexes, or even other asset classes, futures, or even currency, has been. We are ready to move to make use of those platforms. So the higher frequency model, it means first of all, out of different kind of platform, how to choose the best price. We are not trying to buy here and sell there to arbitrage. No. We are trying to execute our trading model as a quantitative systematic manager, and how to find the best price in the market, number one. Number two is, with all this information, instead of minutes or hourly data, actually they are tick data. So it will be one data. And with the capacity of and the help of the computer, actually we can digest this kind of movement into a split of second, and then to decide whether we should buy here at a very fast mode, or we can wait. So this is a kind of artificial intelligence, or you can call it machine learning. So we learn from the keep moving markets. So learn in a way that, for instance, Korean won, I give a good example. 1 US equal to 1,060, 1,062.
No, now it's 84.
Oh, today, 80.
Moves a lot.
Yeah, moved a lot, my goodness. So it's 1080, 1081, for instance. So as an investment manager, you don't want to buy at the high and sell at the low. You want to save this 1-1 spread. So usually, as a manager, we assume the mid-rate. If you can buy or sell at the mid-rate, which is 10x0.50, you are very lucky. So in the past, it cannot be done. Now we believe the skill is more mature, and it can be done now. And also, it can be done in a way, sometimes you can beat the middle rate. Sometimes you can buy lower than the middle rate, or you can sell higher than the middle rate. So all this cushion, or you can say this return, will eventually go back to the investor, of course. So this is what we talk about the high frequency, and pretty much like what I mentioned earlier, that it allows a lot of different strategy which generate really good return risk ratio or Sharpe ratio.
So how about performance since year 2011?
Since 2011, on the higher frequency model, actually is performing pretty well. Rather, the traditional classic way of trading, for instance, currency, has been struggling. Looks like, for instance, trend, we all know that since beginning of this year. Too many central bank intervention. Trend is not a very good alpha so far this year. Carry interest rate differential has been keeping a very high Sharpe ratio in the past, but
It's
may
big
not
gamble.
be this year.
Yes.
Yeah, because all the interest rate is almost zeroized, and we do not have a currency offering 15% and another one or two, so you can have a lot of carry opportunity. So it's a challenge for the trend and the carry module, I think, pretty much this year. But having said that, if we look forward, I believe the trend and carry will perform. Pretty consistently in the future. But at this point of time, it seems, for instance, as I mentioned, the higher frequency model is pretty much good.
Okay, then can you talk a little bit about some macro, your insight? Which currency you want to buy? You need to buy at least one currency when you sell. That is, I think, a definition of a currency exchange market. So
yes, indeed.
Which currency you prefer? You want to sit on US dollars, or you want to sit on euros, or Japanese yen, or Swiss franc, or Korea won?
I think I read an article talking about beta. Beta currency. They are moving on an opposite direction.
Okay.
So it used to be high risk currency. They perform when the global economy is very well, and low risk currency, they perform very poorly until the crisis hit. Then this one go up, and the high beta currency will go down. Yeah, pretty much like Aussie or Swiss franc. But now it seems the Swiss franc is almost at the record high, and Aussie also at the high in the history. So these cannot be consistent for longer.
That's why I'm asking you.
Yes,
it's very confusing after downgrade of US.
I think this is the reason why it happened is because US after the QE1 and QE2, the US dollar become nobody child in the international market. So the US dollar has been sold happily. A lot of people trying to sell the US dollar. And at the same time in Europe, when we are talking about Europe sovereignty debt problem, so we make the euro particularly weak. So the Swiss franc suddenly become a safe haven. So we have a very weird thing, a curve rather than a slope. So looking forward, we believe, unfortunately, our house view, we prefer a view that the market is actually going to possibly a double dip in the global economy. So this double dip is not a good news for the US stock market or to some European debt markets, but it could be very good news for US dollar. Why? Because US dollar actually is the medium of exchange for the global liquidity. When markets is booming, banks actually create more credits. And in a way, the dollar to be recycled into the international market keep going up. With the supply of the dollar keep going up, the exchange rate of the dollar actually will go down. So for instance, if the market is booming, a lot of investment come to Korea. They don't use US dollar to invest in Korea. They sell US dollar for Korean won. So US dollar become weak. But however, when a crisis develop or a slowdown or a credit crunch or austerity is happening, then the opposite will happen. So bank will be reluctant to, lend money. Even we have QE1, QE2 is pretty much limited to the group of banks or the big institution. So it does not benefit the lower walks of life or the lower walks of businessmen. So that's why the dollar supply actually is suffocated. So if our argument in this direction is correct, we will see the dollar actually going back up for the rest of the year. And it will accompany by Swiss franc, which is also a safe haven because of the European problem, and also Japanese yen, and because of the repatriation. And so I think they are the fastest three horses. Who to win, difficult to say, but I can show you the loser. The loser
Commodity-driven countries and also some exporter-driven
Yes, indeed.
countries.
You're right.
Like
So those countries who rely heavily on export, raw material like Australia, New Zealand, they will suffer. I mean, the exchange rate will suffer. We expect them to suffer in the second half, the fourth quarter, into the fourth quarter. And also, we are talking about emerging markets. For instance, in Asia, we understand the Korean won, even the CNY. CNY is a little bit different. It's managed carefully by the Chinese government. And also some other currency like Sing dollar, but they also rely heavily on the export and so all this currency might face different level of difficulties. So the more you rely on export, the more you rely on the import of capital, the more chance for you to depreciate for the rest of the year. So this we expect, for instance, and also don't forget Euro will be one of the problem. So we expect, for instance, Euro towards the end of this year, instead of currently, I think it's about 143, 144 range around. So we expect it to go below 130.
130.
Yeah, by the end of this year. And pretty much Australian dollar has been in a happy
below
range.
Parity, or what do you think?
Actually, it's
below
slightly
parity?
below that.
Parity.
And we prefer the Aussie dollar, a view that the Aussie dollar may go down to closer to 90 cents US.
Sounds like you have to short equities.
Equities.
If your insight is correct, then we better short or
Yeah.
risk assets.
Yeah,
and also
the-
equities.
Equity is always 6 months ahead of economy, right?
That's correct.
So a lot of people told me that. So if we are not as optimistic for the next 6 months for the global economy, particularly the market which Korean investor or Korean exporter are trying to export to US and Europe, then the expectation of the performance or profitability of the company in Korean exporter could be under pressure. So, but I'm not trying to be too pessimistic on that, because I understand a couple of months ago, Kospi is still making the new record high, right? Yeah. Not in August, but still you have different reasons for different market. But basically, I think you're right with the austerity in Europe and the debt crisis not being solved completely, and we are talking about diversion of good economy or strong economy in the north of Europe, and compared with the southern part of Europe, is a cause of concern. And in U.S., we are also talking about, I think it's the first time ever for Mr. Ben Bernanke to leave the Fed fund. Is low until 2013. So it sounds like a free lunch. Too good to be real, right? So it tells you it's part of the thing. So that's why our chairman, sometimes Mr. John Taylor, is also always tell me that actually we don't need a QE3. This is QE3.
Okay. Sounds correct.
Yes. So this is our expectation. So that's why we expect the stock market will still under a phase of further correction, but not pretty much like the 2008.
No.
Then we have a 20-25% or even deeper, and then we gradually have QE1 March of 2009 and gradually go up. What we worry is it will go slow down and then it will drag on for 1 or 2 years. This is painful.
Yeah.
This is painful. Yeah. So this is our view, on that.
Okay. Any comments on currency derivatives market or options market, whatever you want to talk a little bit more?
Yeah, I think other than that, on the currency market, we believe that it could be a very good alternative to the other asset class. We still believe that, but of course, there are two prerequisites. Conditions. You cannot possibly trade one currency pair. Oh, I trade in and out dollar Korean won. I diversify my investment from stock and fixed income. No. You don't do that. You need a group of currency. You need a group of currency. You need at least 15, 20 currency. And you need a system to run the risk carefully. You need to know your risk. And second, it's how to combine the portfolio. It's also a lot of techniques you need to look into. So as long as you choose small currency, not one currency, and you have also your portfolio construction instead of, how can I say, no compliance, no risk management, then that will be a danger. That is called speculation, maybe. But if you are talking about you diversify in a bigger group of currency, and you do have a way to construct your portfolio with risk management and compliance, a lot of things, then you're okay. So that's I try to share with all of you.
Okay, well, thanks for your time, and then maybe we chat later.
Later.
Okay.
Thank you so much.